Coke stock versus Pepsi stock, Co versus Pep. So this video isn't about which drink you prefer. It's about how these two companies compare as investments. And you may have come across the two grouped together if you've ever put together a portfolio of dividend champions. These are companies that have not only paid, but increased their dividend for 25 consecutive years. That's what it takes to join the Dividend Champion Club. Both Coke and Pepsi are dividend champions by this definition. So Coke has had 62 consecutive years of increases, and Pepsi has had 52 consecutive years of increases. And why invest in dividend champions? Why would you be looking at these stocks to begin with? Well, this is an excerpt from our Guide to Dividend Growth Investing, and it talks about how if a company shows you its CV, which states that it has a track record of increasing quarterly payments, then we believe it's likely to continue to do so, especially if it's been able to do that over a long period of time. And this is why dividend growth is so appealing to retirees. You can buy a bond that provides you with a fixed payment every quarter, or you can buy a DGI stock that's highly likely to increase your quarterly payment every year, which helps offset inflation. So that was taken from our report here, Quantigence, A Guide to Dividend Growth Investing. We update this twice a year. It lists the 30 dividend growth stocks that we're holding, one of those being Coke, and that's where we came up against this Coke versus Pepsi dilemma, and that was the impetus for this video. In this strategy, there's 70 plus names to choose from. It's available to our premium annual subscribers, updated twice a year, and each stock in this strategy is assigned a Q score based on 7 factors that you can see here. So here's Coke and Pepsi compared. And we can just go down the line, increasing dividends. We talked about that. Coke has a better track record, so they're rewarded more for that. Market cap, they're just about the same. Yield, Coke has a slightly better yield there. Payout ratio as well. But here's the two main differences. You can see that Coke has pretty strong international sales, and they're rewarded for that. And they also have weaker 5-year dividend growth, and they're actually penalized for that. And you can see here, the end result is a Q score that's roughly the same. So you're looking at two companies that are very similar, and if you're building a DGI portfolio, you might consider these to be an equivalence class, meaning if you invest in one, you get the same exposure as if you invested in the other. So the idea here would be to try to figure out which one is the better investment, and this gentleman here thinks it happens to be Coke. We did a recent piece on Warren Buffett's stock holdings that talked about his investment in Coca-Cola. That started in 1988 when he believed the company's shares were undervalued. He believes this is a forever stock and wants to hold it for the long term. The slow dividend growth recently has certainly been a concern for dividend growth investors, just 3.5% growth every year for the past 5 years. That barely has you keeping up with inflation. But on the other hand, for us, we're quite impressed with Coke's strong international sales at around 66%. Now, this slide here, at the top, you see their portfolio of $21 billion brands, and it's remarkable to see how well Coke has entrenched themselves in cultures around the world. So we all recognize Coca-Cola, right? That sells everywhere, but that's just one of their powerful brands. For example, you see starting at the upper left there, Coca-Cola, then Powerade. You see that green logo with the Chinese teapot? That's one of my favorite teas to drink in Hong Kong, and variations of that brand. I drink it all the time, and only recently did I realize that happens to be a Coca-Cola brand. Same with Aquarius sports drink. Ilohas, that's a Japanese brand. And then on the bottom here, it's quite interesting to see Coke is expanding into other areas. You see here they talk about 27 offerings in the alcohol market that they're experimenting with. And I wasn't aware that they owned Costa Coffee in its entirety. So that's the second largest coffee house chain in the world, largest in the UK. You can see their locations there on the right. And if you travel in these countries, you'll probably, and you're a coffee drinker, you'll have visited Costa Coffee locations. You can see some of the other brands that they're busy growing. So Coke does quite a bit. It's not just about Coca-Cola. And when you look at, you may think to yourself, Well, the market's been pretty penetrated. How much more can Coke grow? Well, this slide was taken from a Coca-Cola investor deck, and it shows how much they think they can grow in terms of the global population. You can see in green the population increase by 2030. People in light, I suppose that's light blue, are non-commercial consumers, meaning they're not consuming commercial beverages. And then in red, that would be the Coca-Cola Company, TCCC. That's their consumer. And then, of course, the gray would be non-Coca-Cola consumers. That means they need to steal that market share from somebody else. But these light blue individuals represent a blue ocean opportunity. And on the left, you can see where they've spelled that out in developed markets, not much growth. But all the growth is going to come from emerging markets. That brings us to Pepsi. Pepsi sports twice the 5-year dividend compound annual growth rate of Coke with an impressive 7%. So that's exceeding inflation. Their international sales are lower than Coke at only around 40%. It's about the same size. But the difference in product offerings is that Pepsi sells food products and drinks. As a matter of fact, the majority of their sales come from savory snacks and other snacking products that they sell. You can see their beverages there on the right make up 42%. And when you look at their brands from an American perspective, these are all common brands. I recognize nearly all of these. And selling international, I think when you look at their brands, one of the differences is that Coke has been able to localize themselves very well in particular areas. And for example, I think Innocent Smoothie, that was a UK brand that was growing in popularity when I spent time in the UK, and they were eventually acquired by Coke, and they had made great inroads in the UK market with their excellent smoothies. So Coke seems to do a good job of canvassing the globe and finding where there's brands that they can acquire and utilize their economies of scale to grow. While Pepsi here, you can see their brands are largely dominant in the United States, and then they push these brands. Of course, you can find Lay's potato chips, though I believe that branding is slightly different in some other countries, the Lay's brand. But Lipton, Pepsi, Tostitos, Ruffles, Doritos, all these you can find in other countries as well. So that brings us to the comparison of these two firms. We wanted to keep this very simple. So we started with a look at gross margin plotted over time. Now, when you think about these firms, you can go back and look at that analysis we did for Quantigence. But if we take a very high-level view and say, which of these companies are able to sell products for the greatest gross margin, so the greatest potential for future profit is what gross margin tells you. Then you just have to squeeze your overheads to increase your operating margin. And you can either increase revenues to increase earnings per share, or you can decrease costs. So gross margin, a high gross margin gives you more buffer. Look at the difference. We see Coke on top. They have between 64%, it looks maybe close to 65%, and 58% over time. We can see that trending downwards in the past 5 years, and it looks like it may be slightly bucking that trend last year, but that's something to watch as they creep along 58%. But below that, you see Pepsi. Also trending downwards, more like the last 3 years, you can see there. But their gross margin is lower, so between 55% and 52%. So what you can then do is start cutting some of the fat. This was taken from a piece that we did on how Coca-Cola is using AI, and it was a very interesting piece, but it pointed to some of the waste that's going on at that company. And this initiative they had called the Opener, it had all these quote-unquote influencers, and you could go down this list and do a quick analysis of what Coca-Cola is wasting time on and look at some of these broken links or these quote-unquote influencers that didn't have any followers. It was clearly something that somebody shouldn't be working on. They probably had an entire team working on that. And it's just, when you have a firm that gets this big with such a discretionary sales and marketing budget, you have to be very careful, and that's where somebody coming in chopping heads is a great idea every once in a while to get rid of fluff like this. But when you look at the end result, the operating margin for each of these firms, you can see on top there, Coke sitting, bouncing off the 20% mark there. So they've done pretty good. And each one of these firms will talk about how, they have all these goals to improve operating margin over time, of course, but the results are what we're looking at here. And you can see for Pepsi, rather concerning. So their operating margin, they're dipping to 10%, and you can see the band at which this fluctuates in. And for Pepsi, what is it, fluctuating between 12 and 18%. But look at for Coke above that, they barely dip below 20%. So seems to be a much stronger business from that perspective. And a better operating margin means a better run business, means future dividend increases. Although Coke is being rather shrewd right now with their increases, you can see here, this was taken from Schwab. I like these little ladders that they build, and it shows every year over the past 7 years or so, the dividend increases. You can see for Coke, quite minimal, right? So 5% was their last increase, and then 2% before that, 2% before that, 3%, right? So very minimal increases, whilst Pepsi, below that, you could see last increase was 7%, and then 6%, 6%. So they're increasing at a much higher pace than Coke, but how sustainable is that? Which brings us to some very basic numbers here. The payout ratio, that's the buffer these companies have. So as long as you have a payout ratio under 100%, you can keep earnings per share the same and increase your dividend without having to increase earnings per share, because that percentage of that you're paying out is your payout ratio. So Coke has a little bit more of a buffer there, and perhaps Pepsi will need to start slowing down the increase at which the rate at which they're increasing dividend. And you can see here the 5-year dividend yield average for Pepsi, 2.76%, for Coke, 2.93%. So typically you'll see a higher yield for companies that are growing their dividends slower, and that's what we see here. 3-year growth rates, 5-year, 10-year, you can read those for yourselves. It comes down to, Pepsi having a 7.8% 10-year growth rate. It actually extends well beyond that. In their investor deck, they talk about a compound annual growth rate of around 7% for quite a long time. And then Coke here, a 10-year growth rate at around 5.7%, so perhaps just above inflation. But what I always come back to when I think about Coca-Cola is this great paragraph, and I'm going to read it. It says, "Several times every year, a weighty and serious investor looks long and with profound respect at Coca-Cola's track record, but comes regretfully to the conclusion that he is looking too late. The specters of saturation and competition rise before him. He hears dire rumors of the inroads made by Pepsi and some new up-and-coming soft drinks, and he reluctantly passes Coca-Cola by. But Coca-Cola steadily sweeps on." That was from Fortune magazine in 1938, before Buffett ever became involved in Coca-Cola. So this company has done very well over the years. There's lots of opportunity for them to continue doing well. And we believe, from our perspective, that Coca-Cola is the better investment of the two. But as I said earlier, they're an equivalence class. You couldn't go wrong with either. So it's almost as trivial as the decision, should I drink Pepsi or Coke? Should you invest in Pepsi or Coke? Well, what you probably shouldn't do is be drinking these beverages. The profit margin on fountain drinks is somewhere between 85% and 90% for restaurants. That's why I never order fountain drinks or any sort of drinks in restaurants, because their margins are too high. Don't spend your money on flavored water. Instead, invest that money in solid dividend growth stocks, and they'll reap rewards for years to come. So I've put up another video here that you might be interested in. Before you click that, please click the Nanalyze logo here on the right, subscribe to our channel, support our work, share this video with your friends or anybody that's interested. Thanks so much for taking the time to watch this today.